All right, you guys check on YouTube. It's setting up right now.
We're live. We're live right now.
Yeah. Welcome out to Tackle Trading's halftime report for today, Friday, February 1st, 2019. It's a pleasure to be with everybody here to hang out on the last day of the week. We got a lot to cover here today. We got a full show plan for everybody. Obviously, we're going to break down the markets by looking at the market indexes, going through the commodities, looking at the currency. We also have to talk about the unemployment report that came out today. And no, we had the best January since 1987, so I'm sure we'll talk about that a little bit. And then we have earnings on Amazon, ExxonMobil, Chevron, Honeywell, Sony, Decker, and Cigna that I also want to update everybody on. But before we get into all of that, Noah Davidson is guest hosting with me today. Coach Noah, how are you doing today?
Well, I am fantastic as always. Glad to be here. It's always a treat.
I prepared for that open.
Hey,
I felt like my open yesterday was not very strong. and the thing about it is, Noah, Tim usually does the open. So I'm usually like the color commentary, right?
Yeah.
And so I felt like my open was really weak yesterday. So I wanted to come strong with it today. Noah, how you doing?
I'm doing fantastic. And I noticed it was polished, Matt. It was very polished.
It's polished. I spent literally 5 seconds thinking about that, but that's what it takes in the quick Twitter era in 2019. Noah, what's your read on the market? Yesterday when we were talking, we were obviously seeing a positive response to the Fed on Wednesday, follow through on Thursday. And then we have a little bit of just kind of, I don't want to say weakness, but kind of a hanging out date. What's your read on the market here?
Well, I think it's definitely, stalling out today, quiet time on a Friday, which is not surprising to me. I mean, if you've had a good week of trading on the breakout earlier, I see profit taking here, and it's hovering out there with that doji. I think 2,700 is a big number for the market. And it just seems to me like it's taking a breather here. I think it's going to continue higher next week, but in the meantime, do you want to open a new trade on a Friday?
No, no. I mean, I might open a couple, but I'm not going to do anything aggressive.
Yeah, but like a non-directional theta trade, you're not going to open up a directional trade on a Friday.
No, I'm not going 4% call options on a swing trade here today on a Friday. I'll probably wait till Monday confirmation. But no, that's been an important storyline we've seen over the course of the last 3 months. As this has been such a news-driven market, whether you're talking about, the geopolitical situations, and there are a plethora of those geopolitical situations, or if you're just talking about, earnings or what happened in the fourth quarter of last year, there's been a lot of hesitation amongst traders coming into the weekend. And this is really kind of par for the course, Noah. But why do traders have some degree of hesitation in a volatile condition coming into weekends?
Well, I think one is they just don't like to open up new trades heading into the weekends because it's the weekend. I think a lot of it has to do with the average personality trait of your active traders. They all tend to be type A personalities, and they've got better plans this weekend. They've already checked out. I remember a saying that I learned when I was newer to trading. It said the only people still trading on Friday are the ones who lost on Monday, Tuesday, Wednesday, and Thursday.
So it's like the gamblers who are gambling on Monday Night Football to make up their losses on Sunday.
Basically, you ring the bell and go home. If you didn't finish your trading week by Wednesday or Thursday, that's the only reason to still be trading on Friday.
It's I was talking to an old school trader one time that used to trade on the floor, and we were talking about the why day traders were really kind of created. And he was telling me, he's like, Matt, the simple reality is that you have variables in the marketplace, right? And you can trade the variables when they come out into the news. So when news comes out during the day, you can take advantage of it. You can adjust stop losses. You can enter into trades. But once that bell closes, and this is back in the 80s before we had all these 24-hour markets and everything. But once that bell closes at 4 p.m., it doesn't open up again until 9:30 the next day. And from 4 p.m. till 9:30 the next day, you have 17 and a half hours where you can have a lot of variables come in that would impact your trade and you have no control over it. When you're dealing with a volatile market condition in a market that we've seen in the last 3-4 months, both ways, up and down for traders, right? Because traders will short and traders will buy. Yeah. So you have so many of these variables coming into the weekend, right? And the biggest variable of them all, and this is the kicker, is that futures market open on Sunday night. That futures market open, when you have the Chinese market open, the Japanese market open, the Australian open, the New Zealand open, and the European open, and the London open, all happen in that time period from about 5 p.m. Eastern Standard Time till 9:30 in the morning on Monday. You have all these variables that really, if you're trading in the stock market, there's not a lot you can do. In a normal condition, nobody cares, but in a volatile condition, people do care.
You remember back, was it 2015 when Chinese yuan was they depegged their currency or unpegged their currency and changed the ratio on it, and it happened over the weekend, and it was that exact same scenario. It was a Sunday night, and all of a sudden my phone blows up. Everybody's texting. Did you see what's going on in China? And
I believe I was one of those ones.
You were one of those people, and so you go back and look at that. And that was just a really sudden night sell-off. And if you didn't have the ability to trade futures and you didn't, you got caught unawares, the market moved down dramatically in those 17 hours you said?
It's right here.
Yeah. Boom. I mean, that's it right there. That's a good example of one of the, it may or may not be a rational fear that's going to happen over the weekend. I'd say 9 times out of 10, nothing happens over the weekend.
No, but even take out that radical example in August of 2015. No, we've seen that in the last 3 months with China. We've seen that literally earlier this month with China. And when you're looking at this on the futures market, you're just seeing an open and a close, an open and a close, an open and a close. But if you look at this on the spiders, which is the ETF that actually tracks the market, you see massive gaps to the downside, massive gaps to the downside. No, this was the actual date when China made that announcement. You gap down 8% on that candle.
Oh, yeah.
So in the futures market, if you're trading futures, you have a market where you can just trade that in. You see a solid movement to the downside. But if all you know is the stock and the options market, and you have no other way of hedging that in the futures market because you don't understand or trade futures, then you're a victim to uncertainty in that capacity. And we just want to shy away from that when you're dealing with a market that is crazy volatile. Now, again, in a marketplace that is normal and, consistent, I mean, we're really not going to worry about that to the same extent. Would you agree?
Agreed. No, absolutely. So that was a really good long-winded explanation of why not to open a new trade on a Friday, right?
Yeah, you got to have some filler in there, buddy. We got time for now. It's a Friday.
Absolutely. Fun Day Friday. Not Scary Day Friday. Fun Day Friday. We're not trying to scare everybody.
Yes, we are not scaring anybody. Friday, fun day. No, you got a good topic you're going to talk about later on today after we get through all these updates. We're going to look at how the MACD and other indicators can help confirm bullish retracements and perhaps bullish breakouts when we're dealing with drop it down to intraday time periods for confirmation. So I'm excited to watch you work on that one, Noah. Let's go quickly through the markets here. And I don't think we need to go through all the 4 major indexes today, do you?
Well, if you've seen the S&P, you've seen most of them. I think the only one that's really lagging, I think you see a little more strength on the Dow, a little less strength on the Russell, which is not kind of what I anticipated, but the Dow actually showed a little life. NASDAQ looks exactly like the S&P. And then Russell's a little soft by comparison.
Yeah, it's been the case with the RUP for the last 4 months. So
yep,
it's been beaten up a little bit. Okay, so let's look at a couple other things here, Noah, before we get into the earnings. I'm going to talk about the dollar, Noah. What's your short-term read on the dollar? It's been a very difficult thing to really trade if you're not a day trader in the currency market. What's your read on the dollar?
Well, I mean, after the Fed meeting on Wednesday, you saw the nice big red candle come in. And I think that's indicative of that soft policy, which, I always look at my chart on the dollar and you have to keep that backdrop of the policy in your mind. And I think that the Fed sentiment on patience on the interest rate hikes, I think they're just being dovish, and so the dollar's showing some softness. I see a kind of a head and shoulders pattern, or it's kind of a messy pattern, but it's got a big support zone there near 95. And there you can
So-
see possible forming head and shoulders on that weekly. Yep.
Mm-hmm.
So
Right
you mentioned
there.
the word patience and a little bit of dovishness. He used the word patience 8 times in his speech. I
Yeah.
think that dovishness was a little overemphasized.
Well,
I heard a little sarcasm in Noah's voice when he was talking about the some degree of patience. That's got
some degree of
a
patience.
little bit of pinch here on the patience, right?
Yeah. Well, I've got my 2-year-old boy. He always is, a little impetuous like 2-year-olds are. And we've trained him to say, I'm so patient. I'm so patient. And he just sounds like Powell. Every time he wants something, he's like, I want that. I'm like, I'm so patient.
He's learning the output already.
He's already got it. So patience is a virtue, except for interest rates. I don't trust the Fed, and even though they sound dovish, I think they will be dovish because they're afraid to slow down the economy. And what was that mandate that you posted on Twitter the other day? The triple mandate.
I said the Fed has a third mandate. It's called the S&P 500.
Yeah, no down days, no down days.
Hashtag no more down days.
So yeah, I think that's killing the dollar strength. Otherwise, the dollar still should be in the pole position for all the currencies because it's got the highest rate of interest. But if they're going to be patient on interest rates, I think that slows down the demand side of it a little bit. So the dollar is soft.
Well, it slows down the demand for treasuries around the world, right?
Absolutely.
If you think we're going to get, and this is what drives me crazy about what the Fed is doing with the interest rate, because there's more markets than just the stock market. You have the commodity market, you have the currency market, you have the treasury market, and interest rates impacts all of those markets. And some of those markets, it impacts them to the negative. So, the Fed just sits there and looks at the stock market. It's like, okay, you are reducing the demand for the dollar. You're reducing the demand for U.S. treasuries by returning to your dovish stage. And so when I'm looking at the dollar, I still have a slightly bearish rating on the dollar. I'm looking at a potential break at 95, but I wouldn't enter into any new swing trade on the dollar unless we see a break of 95. Obviously, day traders will trade within the candles, but 95 is your major support level right here. 96 is going to be important, but the most likely scenario on the dollar in the short term is I see a little bit of neutrality.
Yeah.
Kind of what we saw up here after this trend ended. You saw this neutrality between 96 and 97 and a half. You most likely should see that between 95 and 96 and a half. So keep an eye on 95, keep an eye on 96, and you can trade within those levels, no doubt. But ultimately, the best trade would be on a break of 95 or a break of 96 and a half. So keep an eye on those levels. With that said, let's move on to gold. Noah, I know you're a big fan of gold and silver and precious metals in general. What's your read on gold?
That's a textbook sell signal up there, Matt. Range up, doji, little engulfing bear candle, but I don't see a big drop back. I see a shallow retracement, maybe to like 1310 on the deep side. Mm-hmm. Maybe old resistance, but maybe just a typical 3-day, 4-day pullback. And then another buy opportunity. You do have a little bit of slowing momentum overall in the big picture, but it's still got some good momentum to the upside. And I like gold. I think that there's been a shift in demand in the global marketplace.
Mm-hmm. Wall Street might hate gold, but you know who doesn't? China, Russia,
yeah,
Europe.
It's the truest form of money, right? So
the New York Fed, they don't hate gold.
Nope.
Right. Gold, you got a great read on this. No, it's just slightly overextended in the short term. You're going to see a little bit of profit taking, and quite frankly, if anybody bought that breakout, bought that stay above 1300, I wouldn't blame anybody for locking in a little bit of profit coming into the weekend.
Oh no, and I think it becomes quite mechanical, Matt. I've always had this belief that the market's personality and cycles have a lot to do with the mechanics of order types, like people who trail stops. Well, they're trailing stops. They see the doji, they tighten up the stops. One candle down starts triggering those like dominoes. And the sell-off is mechanical. It's not even psychological half the time. It's just people's trailing stops getting hit. And so you see a bit of a sell. Yeah,
all those stops are now.
They're all hovering right below that support zone. So the minute it breaks,
they're all under 1320.
So as soon as that breaks, you can usually expect a little bit of an ATR type drop. And it's a really, really common pattern to see the market, rise, slow down, and then go drop because it hits all those trail stops. And so, that creates a great buying opportunity, especially if you see the volume start to wane after the initial sell off, like, day 2 or 3, if the volume's dropping, it's a good pullback.
And that's the most likely what we're going to see here. And, I made a wisecrack at that 1320, but there's a reason I said that. You don't need to see the stops to know the mindset and behavior of traders.
Well, we've all read the same books. We've all learned the same general methods over the last 20 something years, 30, 40 years. There's obviously nuances to that, but the overall, the methodology of traders, it mirrors the cycles in the market. And I think it just becomes self-fulfilling prophecy in that regard.
I agree with that 100%.
To do.
At the end of it, guys, gold's a little bit overextended. It is absolutely, obviously understandable to see a little bit slowing down, maybe a pullback, but I'm going to tell you, I'm going to reload on a pullback.
Absolutely. So,
I mean, it's just a matter of patience. Let it set up, let it come back down. Whether that comes back down to 1310 or 1300, as long as it stays above 1300, you got to be bullish in some capacity. So let's move on to crude oil. Noah, we're perhaps triggering on crude oil. It wants to get that close above that 55 handle. We're currently at 54.90. And with crude, I do want to talk about a couple of the earnings announcements here before we actually get into crude, Noah, because this was really kind of the start of earnings season for those energy stocks. You had three big ones come out today. The first one, the big dog of them all in the energy sector, ExxonMobil. ExxonMobil reports earnings shares, and guys, of 1.51 earnings per share against an expectation of 1.08. Revenue came in at 71.9 billion versus an expectation of 74.2. That was an 8.1% year-over-year increase in revenue. And obviously the market is responding bullish. I am taking this as a bullish report. The revenue wasn't there against the expectation, but that earnings per share was just so good. $1.58 versus the expectation of $1.08. You got to give that into a really, really good earnings report. And obviously the market has responded bullish, up 3.63% today, breaking out of the 75 handle, which has been a little bit of old support, old resistance. Noah, is that a trigger and a run and a breakaway for you?
Yes, it is. And with that type of trade post earnings, I tend to become a momentum trader if I think it's going to run, which is a real simple strategy. You put your buy stops above the daily high, you put your trail stops, use that ATR as a gauge, and you just try to ride what's left in the run, because that initial breakout's got a lot of energy, and I have a really hard time being the guy who's buying before the announcement or right after the announcement. I've never liked doing that.
I have a hard time too. That's not me.
I like to see how traders respond first. And the way I look at it is that gap and the highs and the lows, those are the new lines in the sand for the traders. Mm-hmm. And if it takes out the low, it fills the gap. If it takes out the high, you got a runner. And
it really is a simple trade when you have the momentum. And obviously it's not just the overnight action. When we're talking about that momentum, Team Tackle, we're talking about the carry through on the momentum. Mm-hmm. It's not just the initial pop up. We want to see that carry through into the cash open. The overnight you're seeing is this gap in the price. The carry through is when the cash open happens at 9:30 and you see that follow through. And once you see that follow through, now you can drop it down into those intraday timeframes and you say, okay, I have an easy trigger above that 76.50 handle. Whether you put a stop loss underneath this low base or this retracement, or you do the 1.1 ATR trailing stop, that's the trader's choice. But the trigger on that really is easy. Next earnings report. Go ahead, Noah.
I was going to say, think about it this way, Matt. Like, how many people are just like us, like the report, but don't want to take that knee-jerk reaction buy, and then they think about it over the weekend. They're like, yeah, that's a good trade. And then come Monday,
every
more buyers stepping in because they read the news, they had time to absorb the information, and then you see a follow through because it does. Yeah.
Every single individual trader that is aware of ExxonMobil is doing that.
Right.
Maybe not the hedge funds, maybe not the institutions, maybe not the algos, but every individual trader like Team Tackle, like Noah Davidson, like Cody Mackey and myself that are tracking this, we're all doing that. Yep. We're waiting for that moment. And that's a great question. Should you put in both triggers up and down? Yeah, I wouldn't put a trigger on the short side. So if that was the question on the short side, I would not short a strong earnings report. Okay.
Well, if it was a questionable earnings report like Apple, where mixed numbers, mixed
data on Apple though.
Yeah, that's when you do the K trade on. But one where you've got, they clearly didn't just beat earnings; they took it out behind the woodshed and really
they destroyed earnings.
They destroyed earnings. That you don't do that on that.
No. Next earnings report, CVX here. This is Chevron Corporation. Chevron came in at 2.06 earnings per share against an expectation of 1.87. Beat on earnings per share. It also beat on revenue at 4.24 versus a 41.6 billion. Year over year, 12.6% increase in net revenue. And this one I might like even a little bit more than the ExxonMobil earnings report. It beat on earnings per share and beat on the revenue, had a bigger increase on year over year revenue. And this momentum is just enticing.
Well, and that tells you a lot about what's going on in the sector. When you got, two of the big fish knocking their earnings out of the park, you know that the sector's kicking ass right now. Pardon my French.
Well, no, we talked about this last week. What's the best sector coming into February and March?
Energy.
It's energy. Every year it's energy. And it's weird because almost every year it seems like we start a little earlier. Mm-hmm. With energy. I remember
last year was a little soft because it didn't take off to like April, but normally it's February, March, and it's such a strong, it's probably my number one seasonal trade.
I'd say it's even more than the seasonality around the fall with Christmas season.
Yeah, absolutely.
Yeah. Awesome. Keep an eye on that, guys. Love the momentum coming out of Chevron. Another energy stock reporting earnings. Let me go down to the daily chart here. It was Honeywell. Honeywell also gapped up, broke out of resistance, but I want to talk about this because this is the cash open, and we have a different read on Honeywell, obviously, versus Chevron and ExxonMobil. Honeywell comes in at 1.91 on earnings per share, 1.88 on the actual expectation, so they did beat slightly on earnings per share, 9.7 billion across the board. They met that with the expectation, but here's the problem with Honeywell. 10.3% year-over-year decrease in revenue and a slight guidance decrease as well. We did not see a guidance decrease on Chevron. We didn't see a guidance decrease on ExxonMobil, and we saw beats across the board, but Honeywell year-over-year lost on revenue and guidance lowered. So the difference here, guys, is quite frankly simple. Chevron and Exxon had positive earnings reports. Honeywell had a very mixed earnings report. Honeywell lowers guidance, but it's that cash open that's so important. When you're looking at all three of those stocks gapped up. Chevron, ExxonMobil continue the momentum. Honeywell obviously shifts a little bit on the negative. What's your read on Honeywell?
Oh, just like that's the same reason I don't like to jump in and chase the trade that early, because that's when clearly, obviously filling the gap. And that response definitely gives me the idea that, the earnings were mixed review. And so it pops up. If I own that stock and I saw that, my knee jerk reaction would be to sell, just because all of a sudden you're gapping up. Well, how many points did it gap up overnight? 5, 6?
Gapped up. Let's see. It gapped 143. It gapped up about 6 points.
6 points. And then boom. I mean, you get instant selling. That's just a strong indication that they like the earnings, but not enough to keep buying.
It's just the importance of earnings, guys. Mm-hmm. It's not when you're reading the movement, it's not just the initial reaction on the overnight. The importance here is how the market responds on the cash open. And on the cash open on both Chevron and ExxonMobil, you had positive movement coming into it and you had negative movement coming into Honeywell. If you're looking at potential trade here on the bullish side, I wouldn't short Honeywell. If I owned it, I would just get rid of it. But if I was looking at a potential bullish trade, I would rank Chevron 1, Exxon 2, and Honeywell would not be tradable in my opinion right now.
Yep. That would be the one I threw out.
And with that said, let's take a look at crude oil, Noah. I'm excited. Well, let me rephrase. I'm getting excited. If that breaks out of 55,
there,
if that breaks out of 55, where's the projection?
Well, I think 60 is an easy target, but if you back out, there's no reason you don't see it back up towards 65, 70, back, where the old support resistance zones are. So
61st.
Yeah. 61st, 65. Yep.
You're climbing a ladder, 60, 65, 70. It's got to be the target. Now, obviously, a lot of people don't trade crude oil, but if you're trading that breakout of 55 and you're looking at that on USO, you wait for the break on crude, then you make your trade on USO.
Yeah. Well, and if you were to go back and look at, 20 years worth of history and just look at that springtime run, and count the number of times in the springtime it actually ran, you're going to see more years than not, you get that pop in the spring. You can see it right there. Like, early in the year it's popping. So occasionally late in the year you get the move, but it goes.
And the last thing I want to get your take on, Noah, before we turn the time over to you with the fun topic on BK, Toll Brothers, Lear, and TXN with the MACD discussion is, I want to get your read on the VIX here, Noah.
Well, the VIX is a broken indicator, Matt. I don't know why you even go to it Sunday. The VIX at what is it at 16.2?
Oh, I don't care. Let's move on.
I think more than anything, I think that means there's a little bit of premium, and that's, during earnings season, there's going to be premium and options anyway. But the market's a little more vigilant. But as the market continues to rise, the VIX is going to continue to drop.
Love it. Love it. Noah, take over. Go ahead and share your screen, and let's introduce the topic at hand while you do so. So I'm going to turn the floor over to Noah, guys, and Noah's going to do a little bit of fun topic on looking at a couple of those stocks from the scanner reports from last week and potential triggers with secondary confirmation using the MACD. And we're not only going to be talking about MACD here and the trigger on the secondary confirmation, but he's going to show you a really cool technique on when you're looking at on a daily chart and you see your trigger on the daily chart, and then you drop it down into a 1 hour chart to show the confirmation on MACD. Noah Davidson, go ahead.
You bet. All right, you guys see my screen okay here? You got that? Yes. Okay, good deal. So here we're starting out with TXN, Texas Instruments. This is, I believe, off of our scouting report, right? You got a beautiful looking bull pullback, price gapping up with a lot of energy, running off of earnings, hitting the 200 period moving average and pulling back down. And a couple of things just worthy of note is that I like to see on my pullbacks, a lot of volume and energy on the breakout. And then as the retracement's coming in, you're seeing that volume wane. You see, decreased participation in the sell-off. That's really important sign to see that decrease in volume, because then you know that you're not seeing heavy selling. You're not seeing institutions dumping stuff. And so that's the general setup. And you can look at that just nice little bull pullback. And we all know the same signs that we're looking for in the bull pullback. Like, you're looking for those candlesticks to shrink as it drops. You're looking for the bottoms of those candles to get tight. And I remember, Matt, one of the first times I really truly understood momentum was when I was processing in my mind different time frames. And I understood the concept of like a small body candle, like a doji, or a small body candle at the bottom of a pullback. You get that, nice, strong, energetic run. And then as prices drop, you see the momentum slow down and the prices shrink. And it dawned on me, I'm like, oh my goodness, that's slowing momentum on the smaller time frame. I understood it to the point where I was really excited about, that little epiphany I had. And so I ran and looked at my computer, and I just was double checking my thinking. And sure enough, you see, you can see the slowing momentum in the candlesticks. Like, you could measure the distance between, the first candle down here. Let me see. Let me grab my drawing tool real quick. Hopefully this doesn't give us any problems there. There we go. You can see that, the distance between like the bottom of candle 1, group 2, and then all those came in at the same zone. So you had a big drop, it was a smaller drop, and then it all consolidated in that area. So now, one of the things I look for, and one of the first systems I used, Matt, was the good old MACD stochastics combination. And it's really decent for finding the bottoms of like big swing trades. Like, you can see where on this daily chart, the MACD's crossed up, and your stochastics, gave you buy signals, and you can catch those runs on the daily chart. But it's also super effective for catching the bottom of the pullback if you change timeframes. And you can come down and we all,
Can we talk about that real quick? The reason it's so important to change the time frame when you're using lagging indicators, when you're using secondary confirmation, is if you look at the indicator on the daily chart, it has not caught up to the retracement yet. It has not caught up to the price action. And so when you're catching that retracement, it's not the same on breakouts, guys, but when you catch the retracement, dropping that down into a 1 hour chart will give you a much better read on the confirmation. Go ahead, Noah.
Well, no, it's really important, especially for like an indicator like a MACD. I mean, a MACD uses a 12 and a 26 moving average crossover and a 9 period moving average of that. And that's a kind of a lagging set of numbers. Those are not, a 26 moving average is not exactly a fast moving average. So and people will change the settings and try to speed up their indicators and make them more responsive. But at the end of the day, all indicators lag. And the reason you change timeframes is I want to look at this. Like, I like the pullback, and we see the little buy signal. You got your kind of bullish engulfing here. And we all know the triggers: buy above the candle high, stop loss below the candle low. But we take this down and we drop this into, we'll go down into, 10 days or so. I like the 30-minute chart, Matt, because it catches that little that odd half hour you get in the market open a little bit better. And we can bring in our history here. Let me go. I'm going to change the load on that to 20 days so we can see the whole run. Okay, so you got the little pullback in here. This is what you're seeing, a couple of days down on that 30-minute time frame, and you can see like the W pattern forming right here. You can see the general downward movement, maybe even a double bottom. The old support resistance zones in there. And one of the things I look for is this is where you'll see your indicators start to diverge. So an oscillator divergence, anytime you see slowing momentum, oscillators tend to diverge. That means, the stock price was making new lows, but the indicator is diverging and running back up. And that happens anytime you see slowing momentum. So you've got a classic MACD buy signal setting up right there where the two lines cross above zero. Well, if it breaks above the candlestick high, that's going to cross over, right? You're going to see that extra confirmation.
It has to. It has to.
And then you look at another oscillator like a stochastics. All oscillators do this. And so after I learned this trick, Matt, I honestly didn't think I needed my oscillators on the chart anymore because I kind of knew what they'd look like. Yeah. That same slowing momentum pattern, look at the oscillator here. That makes a higher low. So the price drops down and makes this low. And then the next low is lower on the chart, but the indicator reads it higher. And that happens on oscillators. Every time you see slowing momentum, you see oscillator divergence. It happens on tops. It happens on bottoms. And that's that indication of slowing momentum. So the stochastics in this case is already given buy signals. And, by the time the MACD crosses up, that's going to read overbought. So you're trying to use a fast indicator with a slow indicator, and you're trying to marry the two into a confirmation signal. And the confirmation signal, in my opinion, is the divergence here, coupled with the breakout here. And when you get that, I think it would even cross above like Mark's 9-period moving average, like it would even give you that too. So you get a breakout here, and then those two moving averages are crossing over. As you're seeing the fast moving average cross the slow moving average, and you got your MACD buy signal. And it's that multiple points of confirmation. Back in the day, they used to call it the 3 green light system, where if you could get your MACD, your stochastics, and your moving averages to all give you the buy signals, it was more of a position trading type system. But when they would
use those on daily charts.
And so big daily charts, and look for the longer term swing setups where you're trying to capture like the bottom of a correction. Yeah. But to apply it here on like a 30-minute chart, now it becomes a day trader system or a swing trader system. And, it's I think multiple time frame analysis is a really important discipline to help you understand, candlesticks, momentum, confirmation. And for picking entry and exits, Mark might want to buy when it crosses his 9-period moving average. I decided in my trading, I always go with the most universal signal, which is support and resistance. So if it breaks above resistance, I'm in. If it breaks below support, I'm out. I like it when the market establishes really clean lines in the sand between those buy and sell support zones, because those are easy triggers for me, and they become not very subjective as using some other like random indicator that gives you a buy signal. I like to see the confirmation on the MACD, but that's not the reason I buy. It's not because those cross up that I buy. I want to see them cross up to confirm that what I'm seeing. But I'm gonna put my trigger above the resistance.
Well, you're reading the momentum on the daily chart, right?
Right.
You drop it down into a 1-hour chart on the MACD to get, and it's called confirmation, to get confirmation about what you're seeing. And I was the same way with you, Noah. I mean, once I figured out that MACD just uses historical price action, and once you master historical price action, you can kind of tell where the MACD is. But we are all humans, and we all have bias, and we all have flaws. Algorithms and math doesn't. Using a MACD by dropping it down into a 1-hour chart is a great way to get that secondary confirmation. And the thing about it, I absolutely love this chart setup. No, if you'll drop that back down into a 1-hour, not a 1-hour chart, but a daily chart, you take a look at what this trade is kind of setting up as. You have a reversal pattern. You broke out of your reversal pattern. You broke out on strong volume on a positive earnings report out of 100. You hit the 200-day moving average at 105. You retrace back down to 100. You have a textbook retracement coming back down into a very significant whole number in 100. You got an easy trigger above the high of the day, and you got an easy stop loss under 100, and you got an easy target at 105 by about 115.
Yeah, 110, 115 easy targets. Yeah.
Adam has a question for you. Adam says, Noah, do you have an opinion on stochastics versus the relative strength indicator? RSI?
Well, yes, I do have a strong opinion on that. The stochastics was a ripoff of the RSI. Wells Wilder developed the RSI first.
That was a
George Wayne stole his idea, twisted it a little bit, repackaged it, and sold it as the stochastic.
They are similar.
No, they're very similar oscillators, and they actually have I think they have very good usages. In fact, if you're really interested, Adam, go look up the Stoke RSI by Tushar Sandhi and Stanley Kroll. They developed a hybrid of the stochastic and the RSI together. So that's like the love child of
they married the RSI and the stochastic.
They married the RSI and the stochastic, and it was one of the first indicators that I started to back test, because I got Brett Charlesworth, right, Matt?
Oh, of course.
Brett Charlesworth used to run his Metastock seminars entirely off the Stoke RSI, buy and sell signal back testing. And it was a good little swing trading indicator. The question I always have on those is, what's the setting? And on the stochastics, like every software program I've ever looked at has a 14-day setting on the stochastic. And Jeff Crystal used to tell me this funny story about meeting George Lane one day, the guy who developed the stochastic. He says, "Hey, George, why 14 days? And George says, "I never told anybody to set it to 14 days. That was what was in an article that got written on it in Stocks and Commodities magazine. And the number just stuck." Well, and what it was is, back when he wrote the article, and when the article got written in the 80s, the market had about a 14-day cycle. Mm-hmm. Right now, the market's average number of days between support and resistance is 8 to 10. The market moves faster than it did, 30 years ago. Mm-hmm. So I like both indicators. I think if any indicator you're going to use, you want to go read the original source material, like figure out who created the indicator, what their original intent was, because other people come in and use indicators in different ways, and maybe use nuanced interpretations. But if you go back to what the person who developed the indicator was, it was some engineering type, left brain analytic with programming skills, that was trying to build a better mousetrap to help them take the emotion out of their trade and give them good buy and sell signals. They're trying to create an algorithm to make decision making easier. And if you can crawl inside their head and see what their original intent was, then you've got a good understanding of what the strengths of the indicators are, what the weaknesses are. And all indicators have their strengths and weaknesses. Like the MACD lags. The stochastics gets called a leading indicator, even though it lags. It's just fast lagging indicator. But I like the idea of using oscillators in conjunction with like your moving average systems, because the MACD is really good at reading momentum, and the stochastics will give you short-term changes in sentiment. So you can combine like a slowing momentum, and when you get the buy signal on the stochastic, you can get an earlier entry. Like you could have been into this trade here off the W when the stochastics was confirming. The MACD hadn't given you the buy signal yet, but you could have caught the breakout, and you could have already been profitable on this. Earlier. It's a more aggressive entry, but that's kind of the idea behind those. And that's why people like to use multiple indicators. I think there's also a big trap that people fall into, Matt. Too many indicators on a chart.
Oh my God.
Have you ever had you open up somebody's chart and they've got like every indicator possible and thousands of lines drawn on their chart?
You can't even see the candles.
Yeah. It's like, what are you looking at? Which one of these? Which one of these are you studying? Yeah.
You're literally just trying to find any reason to make an emotional decision on those ones.
Right. And that's not really a word, is it? All that most, I think, indicators do is make you feel better about your emotional decision to buy or sell. Mm-hmm. And you're trying to get unemotional about your decision making, which I think for traders is the hardest thing to do, is get that emotion, in check. And I think the biggest key to that is to scale in. So one of my favorite triggering techniques, Matt, on this strategy is I like to scale in. So if I were to go back down into that same kind of 30-minute time frame here, and look at like where my trigger points are. Okay, I could say, okay, I'll put in my first buy order above the high, And then if you get the breakout, almost invariably that breakout retraces. And if you leg in here and then you start to get a higher low up in here, you add to the position. So you go entry one, put in your entry number one, and then this is that old 1, 2, 3 pattern you always talk about, Matt. You get that breakout, short-term day traders take profits. And if you get that higher low confirming, you got entry two as it confirms back up. And you can put the least amount of money at risk when you're first getting into the trade. And then you can add more to the trade as you get that secondary confirmation. And that when I was actively day trading all the time, that was my favorite thing to do, is just scale in on the breakout, buy the small number of contracts or shares, wait for the retracement, add to the position. And then on any pullback you could add to the position. Or any breakout you could add to the position. But the idea of putting all your shares or all your contracts on the table right up front, I think goes against a lot of money management principles. It's like you wouldn't put all your chips on the table when you're playing poker.
No.
You'd wait until, you'd ante into the game, put one chip on the table, see what kind of hand you get dealt, and then bet accordingly.
Scaling in is a great way to limit risk, wait for higher confirmation, and add to a winning position.
Yep. Absolutely. And so, whether or not you're using, multiple indicators or you're using just price action, like a lot of times I just have price and volume on my chart, because you could show me a chart at this point in time. I've looked at enough of them. I could draw what the MACD looks like. Like you show me the chart and I'll be like, MACD is going to look something like this.
Yep.
And sure enough, that's what it looks like, because it has a very distinct personality where it slows down when you see slowing momentum. You get because it stands for moving average convergence, divergence, right? Divergence, convergence. When momentum is increasing, the MACD separates. When it converges, when it slows down, you see slowing momentum. That's when the two lines, pinch together. And so it's MACD is an awesome momentum indicator. I like it much more for momentum than I do for the classic crossover signals. Then, stochastics, I think, is a good oscillating. You're trying to catch those swings. I think the trick with it is trying to get a good setting on it. Thinkorswim's the first platform I've ever seen that default setting to 10 on the stochastic. So it measures 10 days or 10 periods. What was the other symbol, Cody?
Let's go through a couple more. I was just answering a question into chat. BK, let's take a look at BK.
I think that one's my favorite setup. Dibs for the reports.
Oh, that. If I could write a textbook setup, nice little break above the 200. This is the age-old debate that I've had. Is it going to bounce off that 200 period moving average, or do you give credit to old resistance and support in that same price neighborhood? It's that same, if you focus on the 200 period moving average, it's bouncing off the 200.
If you take into account the known levels of support catalyst, right? Moving averages, significant hold numbers, trend lines, Fibonacci numbers, all of those different ways, right? There's about 5 of them. Yep. I like to judge a support level based on not whether it's coming into one or the other, just how many is in that zone. And if it's coming into something like, Bank of New York Mellon Corp is, and you're coming into a 200-day moving average, but you're also coming into an old pivot, that just gives me greater confidence going into the trade.
Yeah, absolutely.
If we drop this down into a 1 hour chart, does MACD confirm that as confirmation?
Well, let's look at it on the daily chart first and see what signs we can see. So here's the thing. Look at the MACD. It's about to give a sell signal here. If it drops any more, yeah. So because it's lagging, it's just barely figuring out that it pulled back. You got the pullback. So the first big red candle down, lots of momentum. The next candle down hit the 200, and then you got this small body hammer here. And I can see the slowing momentum right here. So you go from the first breakdown up here to the next one, you had some good momentum, and then the next candle came in there. So big drop, smaller drop. You can already see it. So as we switch time frames and go down into that, 30-minute time frame or hourly time frame, here we can go 10 days, 30 minutes. There's the slowing momentum we were just talking about.
Okay. So what you guys are seeing here, guys, on this intraday, you see this bearish downtrend. That's the pullback Noah's showing you, and he's showing you that slowing momentum.
Yep, exactly. So we, look at that into perspective. Like, look at where the pivot forms, and you go down and look at the MACD where the pivot forms. You go down and look at the MACD where the pivot forms. You go down and look at the MACD, and these are going lower, but over here, the MACD is going to be going higher. And so as I rescale that, sure enough, do you see where the oscillator shifted from negative to positive? And it registered higher over here. It's diverging. And I believe the stochastics will be doing the same type of thing. Sure enough, it's not as obvious, but it's there. But that's the oscillator.
MACD so much better on momentum shifts than stochastics is,
Oh,
though.
yeah. Stochastics doesn't really do a good job of measuring momentum.
No,
it's more of that short-term close.
You couple this with New York Bank of Mellon Corp is above yesterday's close.
Mm-hmm.
The MACD lines, the moving average, are now across the zero barrier.
Yep. That's
confirmation on the trade.
Yeah. So you put your trigger above that daily candle high and you've got confirmation on multiple time frames. And that's a really beautiful pullback setup. Like go back to that daily chart and it's already got one candle up. I think you could feel comfortable buying it even off of that confirmation. Now, if you wanted more confirmation, put your buy above the high.
Yeah. My only hesitation on this would be it's Friday.
Well, exactly. So come Monday, you got another opportunity.
There's no technical hesitation here. It's Friday. That's the only hesitation because I want to see that cash open on Monday morning to see that positive. So I think going above those highs is probably the best way to go about it. No, I want to get your take on a couple different things here. We have not talked about Amazon yet. Let's go ahead and look at Amazon. Amazon reports earnings last night. Oh, let's look at some numbers here. 6.04 on the earnings per share versus an expectation of 5.65. Beat on earnings per share, beat on revenue, 72.4 billion versus 71.6 billion. So they beat on revenue, they beat on earnings per share, but they're down close to 5% on the day. And that's because guidance got lowered. Now, guidance got lowered just slightly. It was not a big miss, but when guidance gets lowered, and we saw this on Honeywell as well. Honeywell had a positive earnings report until you start looking at that guidance. Guidance is an important thing. Down 5% on the day. What's your read on Amazon?
Well, as far as an Amazon earnings report goes, that is pretty modest reaction. I mean, look back at how it's behaved in the past. You got a lot more gap and movement historically. So that's a pretty modest move. It's right smack dab in between support and resistance. I wouldn't bet against Amazon ever, just because that's
we would not short Amazon.
Yeah, no. Yeah, absolutely not. But I think with that lowered guidance, I'd be cautious, and I probably wouldn't be as directional. I'd probably stick with time decay trades on it.
I think you got perhaps some credit trades here.
Yeah,
maybe a bull put, maybe a bear call, maybe a condor.
Yeah, and you should see volatility continue to drop out for a couple of days and weeks after earnings, because the volatility gets jacked up for the earnings, and then the announcement's done, and then it takes a little while for the dust to settle after earnings. But that's a pretty modest reaction, and it gapped, and then it's just dojiing smack dab between the last two support resistance zones. You tell me which way it's going. I can't read anything on that.
Are you kidding me? I think the best trade's an iron condor. I don't know which way it's going.
Exactly.
Sell at 10 delta. You still have volatility high. Yep. Okay, couple other earnings reports very quickly here. Give me Sony, SNE. Sony Corporation gets absolutely murdered on an earnings report where they reported $2.93 earnings per share against an expectation of 1.90. So they killed on earnings per share. Revenue came in at 21.3 billion. We did not have an expectation on that. So why are they down? They're down because they're 10% down in revenue year over year and a guidance miss as well. The reason this drop is important in Sony is I want to take a look at that weekly chart there. No, give me a 3-year weekly.
Boom, 3-year weekly.
Okay, you have major support at $45.
Absolutely, that's a big support resistance zone.
That's big.
There's kind of a vacuum under there, like all that gapped up over here. Back, that one candle kind of reestablished that gap. So I don't see a lot of price action below that. So if it breaks that support zone, you don't have a lot of old support resistance to hold it up. Like it's pretty nominal. I think that drops to 40 if it breaks 45.
Oh, I think it's a falling rock to 40.
Yeah.
I mean, there's just nothing really there to hold it up. I mean, obviously you have those variables. We talk in probability. So guys, whenever you hear Noah and myself or Tim and myself talk, we're always talking probabilities. There is not a certainty in the market besides time frames, right? Besides tomorrow is Saturday and the next day is Sunday and you have time decay. Next earnings report, just take a look at this one. Rockstar report so far. Decker Outdoors, DECK. Coach Frank on Twitter. I saw you tweet about this, Frank. That's why I added it to the list today. Decker reported at 6.59 earnings per share against an expectation of 5.31. Revenue came in at $873.8 million versus an $826.9 million on the expectation. A beat on revenue, a beat on earnings per share. Came in at 7.8% year over year, increased in revenue. Did have a slight downgrade on guidance. The market didn't care. Gap and broken. Rand, Noah, what's your read?
Well, I think what's interesting is the gap. We all see that kind of evening star type candle out there. Whenever I see that, I think, oh, maybe that gap's going to fill. But look at this. It came down and it hit this old resistance zone almost right there with that shadow. Not quite, but right in that ballpark. And intraday, it came down and boom, it's already shooting back up. So if we drop that down intraday and look at how that really played out, you know, you got your initial selling for the first couple 15 minutes. It's been up the rest of the day. So I would consider you got a buy scenario if it takes out your high. If it took out the low, you could probably expect it to fill the gap. But to me right now, it looks like the initial reaction, other than some just knee-jerk profit taking, there's been some buyers back in there.
Yeah, I'm taking the entire report as positive, and if you do break those highs, you could run on that one. Last one here on the earnings, Cigna Group, CI. While you pull up CI here, Noah, talk about the numbers here. Revenue came, earnings per share 246 versus an expectation of 253. A slight miss on earnings per share. Revenue came in at 14.3 billion versus an expectation of 11.3. Good beat on revenue. Year over year, 35.8% increase in revenue. The slight negative here, guidance was lowered. So a very, very mixed report coming out of Cigna. Noah, what's your read?
Well, that creates a candle pattern that some of you might be familiar with. It's called a high wave candle, which is long shadow, small body. Oftentimes you have like a high wave doji. That is a fist fight intraday. You tell me which way that's going after that reaction. It's been up, it's been down. It's kind of where it opened. I think it'll probably end up closing where it opened. And what I like about it from the bullish side is it came down and came up off the 200. But from the bearish side, it, got smacked down off of the 50. So that's a mixed review on earnings with the guidance. And I think the reaction on the candlesticks also a mixed review. I would wait for it to, again, take out the high or the low for clarity.
You got to stay away from this completely.
Yeah.
I was giving my son, I found this video on YouTube where I was on the podcast and I was talking about, the battle at the 200-day moving average. And I was giving Cam a analogy of the French fighting the Germans in World War I. Well, the French are fighting the Germans right now. Let's just stay away.
Yeah.
Let the Bulls and the Bears play it out. Let's see who wins. And then let's jump on the winner's bandwagon.
That's a good policy. I'm going to wait until the fourth quarter of the Super Bowl to place my bets.
It kind of is, but you can still place your bet, right?
Yeah.
I mean, you guys still place your bet. Go over there to Tackle Trade very quickly. I want to show people something.
Okay. Let me bring that up.
Yep. Okay, guys, go to the Trade Center.
Let me make sure I'm logged in real quick. I don't think I am.
It never reads me as logged in either.
Maybe I am. Maybe I'm not.
You might not need to be logged in to see this, by the way.
Okay, let's go with Trade Center.
Trade Center. Yep. Okay. Go down to Glossary. Okay, guys, we've done a lot of Glossary videos, and what we're trying to attempt to do here is build an entire catalog of terms and terms that are in the financial markets, right? And right now we have over 90 different just terms that we have written definitions on as well as videos on. So for example, scroll down, go to the bear put spread there. And guys, this is available for absolutely everybody, not just pro members. So if you ever have a question on what is a term, what is a definition, because trading can be complicated in general, but understanding the language of the market is very infuriating for new traders. So if you do struggle with terms, if you struggle with those basic concepts of the language of the market, we have over 90 different videos, little 2 to 3 minute videos explaining what the term, what that is. We have a write-up for that as well. So again, if you ever need a term or something, just an understanding, you have this resource available to you at any time. Just wanted to show them that glossary. And guys, we're going to be putting out glossary videos literally 10 at a time every single week until we have an entire catalog of every term every term that we actually care about in the financial market. So you guys should be able to check that there as well. Robert, yeah, we should get one. Robert, I could create an entire class on just how to interpret what the Fed says. It would not be a 2 to 3 minute video. It's not a glossary video. That's a class. All right, just wanted to show everybody that so that you guys can take advantage of that. We are having the scouting report meeting later on today. I look forward to seeing Noah and Cody there so that we can get you guys, for the pro members of Tackle Trade, we can get you some amazing scouting reports this week. Cody, I do believe you're on the newsletter. Noah, are you on a report this week?
I'm on scouting. I'm on the stock report this week.
You're on the stock report this week. So we're going to have some great scouting reports for you guys to use over the weekend, and so you can prepare for the market next week. And if you are not a pro member, you need to become a pro member. Just ask any of our other pro members and they'll tell you it's more than worth it, guys. So make sure to come and join this community, and you can go over to tackletrade.com, click on the where you can just sign up for a pro membership, and you can test it out with 15 free days on us. So nothing to lose there. Outside of that, guys, awesome week hanging out with you guys in the report this week. Thank you so much for coming here every single day. Let's get that 50% Fibonacci up there on the likes. Thank you, Adam. That's very important for us. And on a Friday, we'd like to say thanks for everything you guys do, and thanks for being the best part of Tackle Trading, guys. We will see you over the weekend and in the report specifically on Monday. Tim will be back large in charge on Monday. We'll be back.